Building wealth through dividend investing is a powerful strategy that focuses on generating cash flow rather than relying on market speculation. Unlike other investment approaches that may prioritize short-term gains, dividend investing emphasizes the importance of consistent income from dividend-paying stocks. This method allows investors to benefit from regular cash inflows, providing financial stability and the potential for long-term wealth accumulation. By concentrating on companies that consistently distribute dividends, investors can create a reliable income stream which can be reinvested for further growth. This approach not only mitigates the risks associated with price volatility, but also encourages a disciplined investment mindset. As we delve deeper into this concept, we will explore how dividend investing stands apart from traditional methods, highlighting its advantages and the key principles that can lead to financial success. Emphasizing cash flow over speculation can transform your investment journey into a more sustainable and rewarding experience. Dividend growth investing is a strategy focused on purchasing stocks from companies that consistently increase their dividend payouts over time. This approach emphasizes the importance of cash flow, allowing investors to benefit from both capital appreciation and regular income. Key terms include dividends, which are payments made to shareholders, and dividend yield, a measure of the annual dividend relative to the stock price. Unlike traditional investing methods that often prioritize short-term gains through price speculation, dividend growth investing fosters a long-term perspective. Investors seek companies with strong fundamentals, including a history of stable earnings and a commitment to returning value to shareholders. This strategy not only provides a steady income stream, but also capitalizes on the power of compounding, as reinvested dividends can lead to exponential growth over time. Ultimately, dividend growth investing aligns with a more sustainable and less volatile approach to wealth accumulation. Exchange-traded funds, or ETFs, have become a favorite among dividend growth investors, with funds like Schwab US Dividend Equity ETF, known as SCHD, and Schwab US Large Cap Growth ETF, referred to as SCHG, leading the pack. SCHD focuses on high dividend-yielding stocks, emphasizing companies with a track record of consistent dividend payments and growth. This makes it an ideal choice for those seeking reliable income while benefiting from capital appreciation. On the other hand, SCHG targets growth-oriented companies, which can also provide dividends, albeit typically lower than SCHD. Both ETFs offer diversification, reducing individual stock risk, and are easily accessible for investors. By incorporating these ETFs into a dividend growth strategy, investors can enjoy a balanced approach that combines income generation with potential for long-term growth. This dual focus helps build a robust portfolio that aligns with wealth-building goals. Cash flow is a crucial element in the world of investing, particularly when it comes to creating a reliable income stream. Unlike speculative investments, which can be unpredictable and volatile, cash flow from dividend-paying stocks provides a steady stream of income that investors can count on. This income can be reinvested or used to cover living expenses, making it a practical choice for those seeking financial stability. Investors who prioritize cash flow often find themselves less affected by market fluctuations, as their income is not solely reliant on stock price appreciation. This stability allows for a more strategic approach to investing, focusing on long-term growth rather than short-term gains. By choosing investments that generate consistent cash flow, investors can build wealth gradually and sustainably, reducing the risks associated with speculative ventures. Ultimately, cash flow investing is about creating a dependable financial future. To truly grasp the power of dividend investing, let us visualize how wealth compounds over time. Imagine a chart illustrating a dividend portfolio's growth over a span of 20 years. Initially, the growth may seem modest, but as time progresses, the curve steepens dramatically. This is due to the magic of compounding, where dividends reinvested generate additional shares, leading to exponential growth. For instance, a portfolio starting with $10,000 could grow to over $50,000 by consistently reinvesting dividends. Another chart could depict the difference between a dividend growth strategy and a traditional investment approach, highlighting the stability and reliability of cash flow. These visual representations emphasize that wealth accumulation through dividends is not merely a speculative endeavor. It is a strategic, long-term investment that can yield significant financial rewards. By understanding these concepts visually, investors can appreciate the true potential of their dividend portfolios over time. One common mistake retail investors make is chasing high yields without considering the underlying financial health of the company. High dividend yields can be tempting, but they often signal potential trouble, such as declining earnings or unsustainable payout ratios. Investors should focus on the stability and growth potential of dividends rather than just the percentage yield. Another frequent error is neglecting diversification. Concentrating investments in a few high-yield stocks can increase risk significantly. A well-diversified portfolio spreads risk across various sectors and companies, reducing the impact of any single investment's poor performance. Additionally, many investors overlook the importance of analyzing a company's fundamentals, such as revenue growth, debt levels, and cash flow. By understanding these factors, investors can make informed decisions that lead to sustainable income streams and long-term wealth accumulation. Avoiding these pitfalls can enhance the effectiveness of a dividend investing strategy and foster greater financial security. When selecting the right dividend stocks, focus on the financial health of the company. Start by examining the company's earnings growth. A consistent increase in earnings often indicates a strong business model, which can lead to sustainable dividends. Next, review the dividend payout ratio. This ratio shows what portion of earnings is paid out as dividends. A lower ratio suggests that the company retains enough earnings for growth and stability. Additionally, consider the company's debt levels. A company with manageable debt is better positioned to weather economic downturns and maintain dividend payments. Look for companies with a history of increasing dividends, as this demonstrates commitment to returning value to shareholders. Finally, assess the industry growth potential. Companies in expanding sectors are more likely to achieve long-term growth, which can enhance dividend sustainability. By focusing on these factors, you can make informed decisions that align with your investment goals. Reinvesting dividends is a powerful strategy that can significantly enhance wealth accumulation over time. When investors choose to reinvest their dividends, they purchase additional shares of stock, which can lead to exponential growth in their investment portfolio. For instance, consider a hypothetical scenario where an investor receives dividends from a stock that yields 4% annually. By reinvesting those dividends, the investor not only benefits from the original shares, but also from the newly acquired shares that will generate their own dividends. Graphical examples can illustrate this concept effectively, showing how the total value of the investment grows more rapidly compared to simply taking the dividends as cash. Over a period of several years, this compounding effect can lead to a substantial increase in wealth, demonstrating the importance of reinvestment in a successful dividend growth strategy. Embracing this approach can transform a modest investment into a significant financial asset. Adopting a long-term perspective in investing is crucial for building substantial wealth. Unlike short-term trading, which often relies on market fluctuations and emotional decisions, long-term investing focuses on the fundamental growth of assets over time. This approach allows investors to ride out market volatility and benefit from the power of compounding returns. Short-term traders may chase quick profits, but this often leads to increased stress and impulsive decisions. In contrast, long-term investors can remain calm during market downturns, knowing their investments are grounded in solid fundamentals. By concentrating on quality companies with strong dividend growth potential, investors can create a reliable income stream. This strategy not only provides financial security, but also fosters patience and discipline. Ultimately, a long-term mindset encourages investors to think beyond immediate gains, allowing them to build wealth steadily and sustainably, ensuring a brighter financial future. One notable case study is that of John D. Rockefeller, who famously invested in companies that paid consistent dividends. His strategy focused on reinvesting those dividends, which allowed his wealth to compound significantly over time. Another example is the legendary investor Warren Buffett, who has long advocated for dividend growth investing. Buffett's approach involves selecting companies with strong fundamentals and a history of increasing dividends, resulting in substantial long-term returns. Additionally, the investment strategy of the late dividend investor David Fish, who meticulously tracked dividend growth stocks, showcases how a disciplined approach can yield impressive results. Fish's portfolio demonstrated the power of patience and the importance of holding quality stocks over the long term. These case studies illustrate that successful dividend investors prioritize financial health, consistent cash flow, and a long-term perspective, ultimately leading to impressive outcomes and wealth accumulation through disciplined investing strategies. By staying informed and patient, investors can weather market storms and potentially capitalize on lower share prices, ultimately enhancing their dividend growth journey. During turbulent times, companies may face pressure on their earnings, leading to reduced or suspended dividend payments. This can be concerning for income-focused investors who rely on consistent cash flow. However, understanding the underlying business fundamentals is crucial. Not all companies react the same way to market fluctuations. Strong, financially healthy companies often maintain their dividends even in downturns, showcasing resilience. To navigate these challenges, investors should focus on long-term strategies rather than short-term reactions. Diversifying across sectors can also mitigate risks associated with volatility. Additionally, utilizing dollar-cost averaging allows investors to buy shares at various price points, reducing the impact of market swings. Building a diversified dividend portfolio requires careful planning and strategic allocation across various sectors. Start by identifying sectors that historically provide stable dividends, such as utilities, consumer staples, and healthcare. Allocate funds evenly among these sectors to mitigate risks associated with economic downturns. It is crucial to assess each company's financial health, focusing on their dividend payout ratios and growth potential. Additionally, consider geographic diversification to protect against regional economic fluctuations. Implementing risk management strategies, such as setting stop-loss orders, can help safeguard your investments during market volatility. Regularly review and rebalance your portfolio to ensure it aligns with your investment goals and risk tolerance. By maintaining a diversified approach, you can create a resilient dividend portfolio that generates consistent income while minimizing exposure to sector-specific risks. This strategy not only enhances cash flow, but also positions you for long-term financial success in dividend investing. Investing is not just a numbers game. It is deeply intertwined with our emotions. Fear and greed often drive investors to make impulsive decisions, leading to poor outcomes. For instance, during market downturns, fear can prompt individuals to sell off their investments at a loss, missing out on potential recovery. Conversely, during market booms, the excitement can lead to overconfidence, encouraging investors to chase after high-risk stocks without proper analysis. This emotional roller coaster can cloud judgment and result in significant financial setbacks. It is crucial to recognize these psychological triggers and develop strategies to manage them. Techniques such as setting clear investment goals, maintaining a disciplined approach, and focusing on long-term objectives can help mitigate emotional decision-making. By understanding the psychological aspects of investing, individuals can foster a more rational mindset, ultimately leading to better investment choices and a more stable financial future. To effectively manage a dividend portfolio, utilizing the right tools and resources is essential. Start with online brokerage platforms that offer comprehensive tracking features, allowing you to monitor your dividend income and stock performance in real time. Websites like Yahoo Finance and Seeking Alpha provide valuable insights, including dividend history and payout ratios. Additionally, consider using dedicated portfolio management apps such as Personal Capital or Dividend.com, which help track dividends, analyze growth, and even project future income streams. Spreadsheet tools can also be beneficial for customizing your tracking methods. Furthermore, subscribing to financial newsletters can keep you updated on market trends and stock recommendations. Engaging with online investment communities such as forums on Reddit or investing groups on social media can provide support and share strategies. By leveraging these resources, you can enhance your dividend investing journey and make informed decisions for long-term success. Continuous education is crucial for anyone looking to succeed in investing. The financial markets are constantly evolving, influenced by economic shifts, technological advancements, and global events. Staying informed about market trends allows investors to make educated decisions, adapting their strategies to changing conditions. Knowledge about investment strategies, such as dividend growth investing, can lead to better portfolio management and risk assessment. Engaging with educational resources like books, online courses, and webinars can enhance understanding and confidence in investment choices. Additionally, following financial news and expert analyses can provide insights into emerging opportunities and potential pitfalls. By prioritizing education, investors not only improve their skills, but also cultivate a mindset geared towards long-term success. Remember, the most successful investors are those who never stop learning. Embrace the journey of continuous education, as it is the key to navigating the complexities of the investment landscape effectively. Many people believe that dividend investing is only for the wealthy, but this is a misconception that needs to be addressed. In reality, dividend investing is accessible to all investors, regardless of their financial background. The beauty of dividend investing lies in its ability to generate income through regular cash payouts, allowing individuals to start small and gradually build their portfolios. With platforms that enable fractional shares, even those with limited funds can invest in high-quality dividend-paying stocks. Additionally, many exchange-traded funds, or ETFs, focus on dividend growth, providing an easy entry point for those new to investing. By prioritizing consistent income over speculation, anyone can participate in the wealth-building potential of dividend investing. It is essential to understand that you do not need to be wealthy to start. You just need the right knowledge and a commitment to your financial future. In summary, dividend investing offers a multitude of benefits that can significantly enhance your financial journey. First and foremost, it creates a sustainable income stream, providing regular cash flow that can be reinvested or used to cover living expenses. This steady income is particularly valuable during market downturns, as it helps cushion against losses. Additionally, dividend-paying companies often exhibit strong financial health and stability, making them more reliable investments over time. The power of compounding also plays a crucial role. Reinvesting dividends can accelerate wealth accumulation, leading to exponential growth in your portfolio. Furthermore, dividend investing promotes a long-term perspective, encouraging patience and discipline. This approach contrasts sharply with speculative trading, which often leads to emotional decision-making. Ultimately, embracing dividend investing can pave the way for financial independence and security, making it an appealing strategy for investors at any stage of their financial journey. Embrace the journey and stay committed to your long-term goals. Start your own journey by setting clear financial goals. Determine how much you want to invest and the income you aim to generate. Begin by researching dividend stocks or exchange-traded funds that align with your objectives. A practical first step is to open a brokerage account if you do not have one. Look for platforms that offer low fees and a user-friendly interface. Next, create a watch list of potential investments, focusing on companies with strong financial health and a history of consistent dividend payments. Consider starting with a small amount to build your confidence. Lastly, remember to reinvest your dividends to accelerate your wealth accumulation. As we conclude our exploration of dividend investing, it is essential to emphasize the long-term benefits that come from patience and discipline. Unlike speculative investments, which can lead to quick gains or losses, dividend investing requires a steadfast approach. Building wealth through dividends is a gradual process, where consistent reinvestment and time work in your favor. The power of compounding means that even small, regular investments can grow significantly over the years. By focusing on high-quality dividend stocks, investors can create a reliable income stream that not only withstands market volatility but also flourishes in the long run. It is crucial to remain disciplined, resisting the urge to chase fleeting trends or high yields. Remember, successful dividend investing is not about immediate gratification. It is about cultivating a sustainable financial future. With patience, you can reap the rewards of your investments, ensuring financial security for years to come. As we conclude this exploration of dividend investing, it is essential to remember that our primary goal has been to educate and empower you. Investing is not just about numbers. It is about building a sustainable future through informed decisions. We encourage you to take the insights shared in this video and conduct your own research. Understanding the fundamentals of dividend growth investing can significantly enhance your financial journey. Always consider the unique circumstances of your financial situation and investment goals. Remember, patience and due diligence are key to successful investing. The world of finance is vast, and the more you learn, the better equipped you will be to navigate it. Whether you are just starting or looking to refine your strategy, your commitment to continuous education will serve you well. Thank you for joining us, and we wish you the best in your dividend investing endeavors.